Hello again. I am Katrina the Advisor and excited to be back. Took some time off to work through the summer and do some conferences and all of those good things, but I definitely want to come back and let this big, beautiful bill settle to talk about the pros and cons of it. So today I want to talk to you about, is the big, beautiful bill beautiful for an individual that's making under $100,000? Or over $100,000. We're going to talk about some of the key features from this new bill that are going to impact you this upcoming tax season, and then some that are going to impact you for permanently moving forward, and then some are temporary. So let's talk about the key changes that are happening with this big, beautiful bill that took effect on July 4th of this year, but is going to impact your 2025 tax returns coming up. Some things are good, some things, eh. All right. So we're going to talk about what that is. And let me share my screen. I'm going to add this on here. So one of the things I want to focus on, and I'm looking down because I'm looking at my notes here. So some things that are staying the same, which I'm surprised about, was the tax brackets were kept the same, right? So there's still the 7 tax brackets, 10% all the way up to 37%. I was under the impression that that would change because a lot of the things that have happened since Trump took office back in January has lined up as instructions with Project 2025. A lot of the things that were listed in that doctrine, or whatever they're calling it, is really has been in alignment with some of the activities that have happened, namely being day one was all the executive orders that was outlined in Project 2025. And then the next thing was taking over all the federal agencies, which we saw with Elon. So the step 3 was really tax reform. And one of the things that was outlined in there was just going to 2 brackets, 15% bracket, and I think a 30% bracket. So I was wondering if that was going to happen, but I think that was too big of a change to push through at this time. So we're still with the same 7 brackets, which is good because we have a progressive tax system. So you don't get taxed at 37% fully. You get taxed at different intervals based upon where your income is at, right? So that's a benefit to most people, right? Also, another thing that stayed the same was the mortgage interest deduction. So you can still write your mortgage interest off that you pay on your primary home. Of course, you can write it off on any rental properties, as always. The one thing that's going away, and I was kind of surprised by this because this was a huge benefit to a lot of tax clients, including myself, right? So the energy efficient credit. So one being the electric vehicle credit of up to $7,500. That expires as of 9/30. There's so many things that have changed. This is why I've been kind of hesitating on jumping on here to talk about some of these things, because some of the stuff is changing as we're talking about it, right? So they're adding extensions on certain things. But as of today, what's today? August 26, 2025. As of today, the electric vehicle credit is scheduled to sunset on September 30th, right? Another thing that's going away is the home improvements. So if you were doing like energy efficient windows and solar installations, that sunsets after 2025. So December 31st, those credits go away for those things too. So those were actually really, really great credits. So I'm really kind of sad to see them go. I think one of the incentives was to get people to, get more energy efficient. So I'm surprised that that became one of the one of the sticking points of something that was being trashed. All right, so let's talk about what's new. There's some cool new things. One being that the standard deduction amount has increased. So if you're married filing joint, last year you were able to take $29,500 standard deduction. And this year you're able to take $31,500. It also increased for all filing statuses. So if you're single, it went up to $15,750. If you're head of household, it went up to $23,625. Last year was $18,000. So that is really, really cool. So those and basically standard deduction, and I'm only saying this for those that don't know, the standard deduction is the amount of your income that you get to keep tax-free off the top, right? So if that number is higher, then you get to keep more of your income tax-free. So let's say if you're at $100,000 and you're married filing joint, $31,500 of that, if you're using the standard deduction, would be what you get to take off the top tax-free, right? So we threw some other things in there that you get to do some additional tax savings. I say you did your 401k, you did an HSA, all that money would be squirreled away, and then you get to put that away tax-free, right? So that's really cool. So the more money you can save on taxes, ultimately, anything that's going to allow that to happen is a benefit, right? The one new thing another new thing is the deduction for auto loan interest. So this is interesting. So if you have a personal vehicle, you can deduct the loan interest up to $10,000 for tax years 2025 through 2028. The reason I said for your personal vehicle, because of course you can already write off for your business vehicle use, right? So this is for your personal vehicle use. So I'm not exactly sure how this is all going to play out, what form is going to come out with this. It's interesting that the timing of all of this, because the IRS is in the process of working on forms for the upcoming tax year. So it'll be interesting to see what this form looks like, what you're going to have to do this. 9 times out of 10, you're going to need to use if the lender is going to send you an interest statement similar to how they send out an interest statement for your home. So we'll see what happens with this, but this is a cool additional deduction of your auto interest. And if you've got a high interest rate loan, this is major for you, because some loans, especially if you got a predatory type loan where the interest rate's 20 some percent, you can hit that $10,000 pretty fast, right? So that is a really cool, and that's a 3-year deduction. So take advantage of it. It's not permanent. Also, another thing that's not permanent, I've heard a lot of talk about these two items, is the overtime pay deduction. So I'm hearing a lot of people saying that you get to write off all your overtime. Not true. You get to write off your overtime up to $12,500. It's only in effect from years 2025 through 2028. And there's also phase out limits. So if your income is a certain limit, that deduction phases out. Now, how this works is this is a deduction. So you don't get to not apply that to your tax return. So let's say, for example, you made $50,000. It's some of that would be, and some of that is overtime pay. Then you would still get your W-2 with that information on it. You would just be able to take that deduction on the overtime portion on that, up to $12,500. Now, remember, the IRS mostly acts like a scale. When you start to go up in the scale on one side, they start to take you down on the other side. So there are income limitations. Once your income gets to the certain point, that deduction goes down, right? Same thing with the qualified tip income deduction. So a lot of people are talking about you get to take off all your tips. No, not all of them. You get to write off up to $25,000 for years 2025 through 2028. Same thing, income limitations, right? So up to $25,000. So it's not all your tips, but you still have to, it still gets put into your tax return, and then you get to take that deduction on the second part. So remember, taxes, and I'm going to talk about this at another time, taxes really falls into, when you're filing taxes, there's really 3 buckets, right? One is the income bucket, where we're combining all of your income to see what you're going to be taxed on, right? So that's section 1. Section 2 is the deductions that you get to take, these qualifying deductions that you get to take. Section 3 is credits, right? So these are the things that you've prepaid. So the money that's been withheld for your federal taxes, the money that's been withheld for your state taxes. So it's really 3 buckets: combining your income, subtracting your deductions, applying any credits, and then what's left over is the net. Do you owe, or do you get a refund, or did you balance out at 0? That's the whole of taxes, right? I simplified the heck out of that, didn't I? And then the other cool thing is the expanded child tax credit. So this is a permanent change. So this is really cool. So this increases the child tax credit to $2,200 per child. Last year and the prior year was $2,000 per child. Remember, this is under age 17. So the child tax credit goes away after age 17. Let me clarify that. It goes away the year the child turns 17, not after 17. So a lot of people are surprised the year that their kids turn 17, that child tax credit goes away, because it goes away the year that they turn 17, not following. It seems like it would be nice if it was following, right? But that's pretty cool. So $2,200, and that is a permanent change. So that's going to be there, right? What's new? Let's talk about some of the new changes. The increased SALT cap tax, right? So SALT stands for state and local tax. So there are, if you itemize your deductions, so we talked about the standard deduction, that's where you get to take so much off of your income and keep it, tax free. You get to take that off the top, right? Well, sometimes if you can itemize, if you can go above that standard deduction amount using a Schedule A, if you can go above that standard deduction amount, then you get to take a bigger deduction off of your income, right? So the SALT cap impacts that that itemized deduction piece, right? So there was a limit on how much you could a limit on how much you could take as for state and local taxes, right? So the limit was $10,000, which was okay for most people in most states. Whereas if you lived in a high tax state, or especially a high property tax state like California, like New York, like New Jersey, 9 times out of 10, you were paying more in local taxes and property taxes and that sort of thing, right? So you were paying above $10,000, but you were capped at $10,000. What this rule allows you to do is go up to $40,000. Now, in most states, I'm in Michigan, a lot of people won't be able to use this benefit. This is on your personal residence. This isn't on rental properties or anything. This is on your personal residence. So this includes the property taxes, the local taxes that you pay, the state taxes that you pay. So if it's above that $10,000 cap, now you can go up to $40,000. The thing is, it does have a phase out. Remember, I talked about how the IRS has this scale. Once you start to balance, you start to go above in the income section, that credit starts to go down, right? So this is the cap increases to $40,400 in 2026, and it increases by 1% every year through 2029. 2029, it is gone. The other thing is if your income is above $500,000, you're phased out of this. But the closer you get to that $500 in income, the closer you get to it, the more that this cap starts to phase out, right? But really great credit for really great benefit for those that are in those high tax states. So if let's say you're paying $40,000 in those state and local taxes in that area, you get to itemize. And if you itemize that $40,000, let's say you were originally just married using the standard deduction for married filing joint at $31,500. Now you get to go the full amount of your this in this area. So you'll also in this itemized section, you get to also deduct your medical and dental expenses out of pocket. You also get to deduct your mortgage interest on your personal and secondary home. Like if you have a vacation home, you get to write the interest off there, and also your charitable donations. So with this increase in this area, if you can itemize, your itemized amount can be tremendously increased, which means a huge write-off for you. Right. So that's a huge perk. So I love that one. Also, there's an enhanced deduction for seniors. So there's an increased standard deduction up to $6,000 for people that are age 65 and over. This is only good through 2028. So it's a limited provision as well. But still, hey, we take how we can get it, right? Also, extended qualified business income deduction. So if you have a business, you get what's called QBI, right, on the earnings. So there's a 20% deduction on your self-employed income. This has been permanently extended, which is great because this is a huge another deduction to lower your income that you're taxed on, especially as a business owner. A lot of the things in this new bill really benefit business owners and investors. So get a business and start investing, right? So definitely business owners are huge benefactors of this. Real estate investors and definitely business owners, small business owners. But this deduction applies to business owners being able to take an additional 20% deduction on the income that you've earned for your business. That's permanent, right? And that's pretty much it. So there were a lot of changes that were talked about that didn't necessarily happen. But one of the ones that I think that are the coolest one, and I didn't highlight it here because I wanted to talk specifically to individuals. One of the coolest ones is the permanent provision for the bonus depreciation being 100%. So especially if you're a real estate investor, that or business owner who needs to buy equipment or things of that nature, that is huge. That 100% permanent deduction. We thought it was going to be phased out next year. So this is like that's like one of the sweetest spots in this bill for me. There's a few things I think if you're making under $50,000, then this is going to be a huge impact because a lot of people that are making under that amount are part of are also receiving a lot of social programs. And the big beautiful bill is demolishing a lot of the social programs, the food benefits, the any social services, Medicaid, Medicare, all of those things are being dismantled in a lot of ways. So, I think we'll talk about that in another video because I'll get on my soapbox on that. I just wanted to highlight some of the key benefits for those that individuals that for this year for 2025 preparing for your tax services, right? So just thinking about some of the additional things that you can do before the year ends because we're heading into Q4 real fast. The way time is moving, we'll be in January in no time. Again, I am Katrina the Advisor. Wanted to come to you and give you a little oversight on the big, beautiful bill, OBBB. And I will be back with you. Feel free to drop any questions or comments that you have in the comment section, and let me know if any topics you want me to discuss. And I'll be chatting with you soon. Talk to you later. Have a great day. Bye bye. Oh, like, follow, and subscribe. I always forget to say that. Talk to you later. Bye bye.